Have you ever felt like you're leaving money on the table when it comes to the IRS and your tax bill? In a recent video we did, we went over 3 high-impact strategies for business owners making over $1 million. If you haven't seen that video, go look it up. It's pretty great. But the third strategy that we touched on was a broad category of tactics related to real estate. Expanding on that, today I'm going to walk you through how to attain real estate professional status for tax purposes. Hi, I'm John Norbert, and welcome to the Financial Prof series. Now, at this point in the video, you might be asking yourself, but John, I already own a business, so why on earth would I want to switch careers and go into real estate? Well, maybe you're a successful lawyer, or maybe you're a doctor who owns a clinic, and maybe you already have a rental real estate portfolio. But here's the rub. If you have real estate professional status, it allows you to deduct the losses from your real estate activity, which for most people, that is their rental portfolio, and deduct those against your taxable income. But it doesn't mean that you suddenly have to switch careers, particularly if you are married. A very simple but very effective strategy that we use all the time for our business owner clients here at Norbert Wealth who have spouses is to have that spouse be the real estate professional. This can potentially work even if the spouse has a part-time job elsewhere. So there are 3 requirements to be a real estate professional for tax purposes. The first is that you have 750 or more hours devoted to real estate activities. Now, there are actually 11 real estate related activities that qualify, and you can navigate on over to IRC section 469 if you want to learn more. Great bedtime reading, by the way. But for most people, that's going to be working on your rental properties. It's going to qualify you. So requirement number 2, right? Requirement number 1 is 750 hours or more. And requirement number 2 is that the time you spend on the real estate piece of your work is more than you spend on your other job or jobs. And requirement number 3 is that you materially participate in these real estate properties as defined by publication 925. Again, this is great bedtime reading if you want to navigate over to the IRS website. So, quick example, you can't just hire a management company and then use the time that the management company spends on your properties to count towards that 750 hours. It sounds crazy, I know, but people try a lot of things, right? Now, if you're wondering what kind of weekly commitment you'd be looking at, that it does equate to 14.42 hours per week. In other words, if you or your spouse can legitimately say that you or he or she spends at least 14.5 hours or so per week on real estate activities, and that equates to more than what you or he or she put into your other professional occupation or occupations, you can legitimately claim real estate professional status and use the losses from your real estate rental portfolio to offset the income from your other sources. So, why is this such a big deal? Let's give you a quick example. If your spouse has a part-time job where they work 12 hours a week, but the real estate activities take up 15 hours per week, the good news is you can probably claim real estate professional status as that spouse. Now, why would you want to do this? Again, this is where it gets really fun. This is the example. So let's say you're a business owner. Maybe you're a lawyer or a doctor who owns a clinic. The key piece is that you're making a lot of money and that you have a rental real estate portfolio, right? So let's walk through this case study. Let's just say you're making $1 million a year, but you also have this portfolio of rental properties, right? And maybe because you've been watching our other videos, you've done a cost segregation study and maybe some upgrades to the properties this year, and altogether the portfolio generates perhaps $500,000 of losses, right? For taxable purposes. Now, ordinarily, you'd only be able to deduct that $500,000 against whatever income those properties produce. But because you're watching this video as a couple, you decided that your spouse would attain the real estate professional status for this tax year, which means you can then pass through that $500,000 of taxable loss and use it against your ordinary income, which again, assuming that that's $1 million, you have now cut your taxable income in half. That means that you've also potentially dropped a tax bracket according to the federal brackets, and this is before we even get into any state or local taxation, right? This can be an enormous benefit because now let's just take the strategy out over the next 10 years. At that point, if the federal code remains largely the same, we'd be talking about potentially well over $1 million, possibly multiple millions of dollars in actual taxes saved. Imagine what that could mean for you or your family if you had an extra million or two or three sitting in your pocket rather than those of the IRS, right? So one note of caution. If you watch this channel, you know that we don't advise people to go do things willy-nilly and then go get audited, right? This strategy does tend to see a slightly higher audit rate from what we've heard from our CPA partners. So how do you prepare for that? Well, a really easy way to do that is documentation, right? Documentation is going to be key. And a very easy, simple way to do that, if you're the real estate professional status spouse, is to download an app like Clockify or Toggle, some sort of time tracking app, where when you're working on real estate activities, counting towards that 750 hours, you could just put it in on the app, hit the start button, and then when you stop working on it, just hit the stop button. That way, if the IRS ever does come knocking, you'll be able to pull out a log that you've been creating all this time, and they'll see, oh, yep, great, he or she is doing exactly what they said they were, this qualifies, we're all good here. So, if you found this video interesting and you'd like to perhaps learn more, or want to talk through what an implementation of this strategy could look like with your CPA or tax accounting professional, we'd love to hear from you. Go ahead and drop us a line, and in the meantime, give a like and a subscribe here on the channel if you'd like to learn about other financial and tax planning topics. And in the meantime, I'll see you out there.